So prices are going up, and I bet there's one question on your mind. What is the smartest way to protect your money? Well, in this explainer, we're going to break down exactly what the experts are recommending. Let's get right into it.
And this is a really urgent question for anyone with savings or investments. I mean, think about it. When inflation is ticking up, if your money is just sitting there, it's actually losing value every single day. So the real question becomes, how ready is your portfolio to handle that?
And look, this isn't just some abstract economic theory. This is the real deal. The latest number from August 2025 shows consumer prices jumped 2.9%. That's the fastest we've seen all year, and it's a huge signal that inflation is a challenge we're facing right here, right now.
Which brings us to a pretty stark warning from economist Justin Wolfers. His advice is crystal clear. In times like these, cash is not your friend. It's like having a slow leak in your wallet. Every single day, that cash is buying a little bit less than it did the day before.
Okay, so if holding cash is a losing game, where are you supposed to put your money? Well, this kicks off what we call the hunt for inflation hedges. We're looking for those financial shelters that can protect your portfolio from this inflationary storm.
And this is so important to get right. The real win here isn't just about watching the number in your bank account get bigger. The actual goal is to make sure that a year from now, 10 years from now, your money can still buy the same amount of stuff or, hopefully even more. It's all about that purchasing power.
So when you ask the experts, they usually point to three main tools in the toolkit. You've got stocks, you've got commodities, and then you have these special government bonds called TIPS. So let's break down each one of these.
All right, so now we get to the fun part. The reality is there's no single perfect solution here. So what we need to do is really weigh the pros and cons to understand what each of these assets can do for you, and just as importantly, what they can't.
Okay, let's kick things off with the big one, stocks. If you look back through history, stocks have proven to be one of the most reliable ways to beat inflation over the long run.
But, it's kind of a double-edged sword. On the one hand, if you look at data from Goldman Sachs going back to 1980, stocks have consistently delivered returns that are way above inflation. But on the other hand, you can't just throw a dart at a board and hope for the best. Some sectors do way better than others, and you always have to be ready for that short-term volatility.
And you can really see this difference in the numbers. For example, energy stocks have historically beaten inflation about 75% of the time, which is amazing, giving you an average real return of about 13%. Real estate investment trusts, or REITs, they also do pretty well, outpacing inflation about 2/3 of the time.
All right, let's move on to our next option, commodities. The best way to think about these isn't as a long-term plan, but more as a powerful shield for when inflation suddenly spikes out of nowhere.
So here's the trade-off. An analysis from Goldman Sachs found that a surprised 1% jump in inflation can actually lead to a 7% real return for commodities. And gold is often the star player there. But, and this is a big but, that same research says they're one of the worst long-term hedges, simply because their prices are just all over the place.
And that leads us to our third and final option, Treasury Inflation-Protected Securities, or, as everyone calls them, TIPS. These are special government bonds that are specifically engineered to fight inflation.
So, what's so great about TIPS? Well, they're directly tied to inflation. When the consumer price index goes up, the actual value of your bond goes up with it. It's a direct shield. But here's the catch. When interest rates go up to try and tame that inflation, the overall performance of these bonds can take a hit, which frankly has been a disappointment for a lot of investors lately.
But still, even with that catch, the expert consensus is pretty clear. As Justin Wolfers puts it, because they're backed by the government and they're indexed to inflation, they are still one of the absolute safest bets you can make if your main goal is to protect your original investment.
So, after looking at stocks, commodities, and TIPS, you might be asking, okay, which one is the winner? Well, according to the experts, the real answer isn't to pick just one. It's to build what they call a diversification defense.
And this is probably the most important thing to remember from this whole discussion. There is no magic bullet. There's no single investment that will perfectly protect you in every single situation. Searching for that one perfect hedge, well, it's a fool's errand.
So instead, what analysts at places like Fidelity suggest is building a team. You use stocks, especially in the strong sectors like energy, for your long-term growth. You add in real estate through REITs to act as a buffer. You incorporate TIPS for that direct guaranteed protection. And maybe you hold a small amount of commodities for those unexpected inflation shocks.
So let's just boil this all down, right? The core strategy is diversification. It is your single strongest defense. By spreading your bets across different assets that do well in different situations, you just dramatically improve your chances of keeping up with inflation, no matter what it decides to do.
Okay, so this brings us to one last, and honestly, maybe the most important piece of the puzzle. Protecting your money isn't just about what you own, it's also about how you think. It's about avoiding a really common mental trap.
It's something called the money illusion. Basically, it's the trap we fall into when we get fixated on the number of dollars we have, let's say you get a 5% return on an investment, without stopping to think that, hey, inflation might be at 3%. So in reality, your actual purchasing power only went up by 2%.
And Justin Wolfers puts it perfectly here. This is the mental shift you have to make. Anytime you're looking at dollar amounts, whether it's a pay raise or your investment returns, you have to ask yourself, okay, but what does this look like after inflation? Don't get fooled.
Because really, at the end of the day, this is what it's all about. The goal isn't just to have a bigger number in your account. The true measure of success, especially in a world with inflation, is protecting and hopefully growing what your money can actually buy.
So, I'm going to leave you with this one last question to think about. Take a good look at your own investments and ask yourself honestly, is my portfolio built for the real world? Is it really truly built to protect what my money can buy?